We have with us Karan Taurani, who's joining us this morning to give us his perspective on one, how Q1 has gone, and second, what's standing out for him with regard to Nykaa in particular, because there's a target price upgrade there that you've given Nykaa post the Q1 numbers. Karan, first let's start with that. What's keeping you positive with regard to Nykaa, and what's changed versus maybe pre-Q1?
Hi, morning. It's a pleasure to be here.
Great having you.
I think specifically on Nykaa, there are 4 or 5 reasons why we are more positive on this name. We have upgraded our target price from 400 to 475 because we believe that the next 3 years, structurally, the company could continue to grow at this kind of growth rates. So I think the first thing is the premium user smartphone base. I think India as a market, the premium smartphone user base growth rate is almost about 25 to 30%. And there's a direct correlation of this with Nykaa's customer base. And going ahead, this number could converge to 20%, but even Nykaa's growth rate, what we pencil in right now in terms of estimates, is around 20% for the user growth. So I think 23-25% growth rate for the BPC segment for the next 3 years is a good enough trigger for Nykaa. That's the first thing we're trying to say here in the report. The second, we're talking about basically the quick commerce business. I think quick commerce invariably has seen a negative impact on the overall PPC market as a whole. Potentially, we all thought that quick commerce will eat up into market share of even companies like Nykaa. But as per data, over the last 5 years, a quick commerce market share within online BPC has moved up from 2% to 17%. But in the same time frame, Nykaa has lost only about 4 percentage point market share, which means invariably QC is gaining at the cost of offline channels, at the cost of other larger platforms, and not majorly at the cost of Nykaa. I think given where things are, I think, Instamart and Zepto obviously will coexist in the ecosystem with the larger players like Amazon, Flipkart. But whatever you're going to see in terms of runway, firstly, I think within online BPC, QC as a channel will kind of plateau to 30% in the next 2 to 3 years. And whatever gain that they see going ahead as well is going to come majorly from the other platforms, which is the likes of Amazon, Flipkart, which is cannibalization of their own e-com market share. So I think Nykaa potentially can even get back market share. They can even kind of get back some bit of take rates because they also saw a lot of discounting in the BPC vertical as well. So some bit of margin cushion therein as well. And globally, it's a phenomena. I think globally specialized BPC platforms have maintained their moat despite large horizontal platforms getting into the foray. So that, kind of gives us confidence on Nykaa that the QC competitive intensity is largely behind us. And going ahead, you'll see market share gains for Nykaa, which is lost in the last 3 to 4 years. Third, invariably point here is the unit economics. I think it's got a far superior unit economics as compared to any other platform in the country. Whether you look at the AOV, whether you look at EBITDA per order, Nykaa really stands out over here, right? And I think if you look at the mix as well, so despite them going to non-metro markets, despite them having a reasonable share as far as non-metro market revenue is concerned, their AOV is extremely strong. So I think this gives them a cushion in uncertain times that tomorrow if there's an inflation in terms of fuel, or if there's some issue on gig worker, increased payouts on delivery, they are well protected over there because their fulfillment cost as a percentage of AOV is only about 5%. And if you look at other platforms, it's in the range of 20-25%. So I think there's a cushion over there. Plus, I think if they increase the platform fee for the Nykaa is actually the lowest as compared to other e-commerce platforms. If they increase that, there could be further cushion on the margin. So I think last but not the least, it's the financial health as well. So very healthy, cash conversion, 65% in line with global peers and global BPC platforms, which is far superior as compared to any other Indian platform today that we have. And of course, the return ratios being the strongest as well. They operate ROEs of more than 20%. Potentially, they could go to 30% plus in the next 3 to 4 years. So all in all, I think valuations are definitely premium for Nykaa. But what's riding our conviction is, of course, this growth rates could, kind of be the way they are, healthy, even after FY29, given these opportunities that we see in the market today.
Karan, one of the key, challenges for many of these companies, including Nykaa, is the distribution network, and that would mean that putting in more fulfillment centers there. As you said yourself, there's a challenge which is coming from QC with respect to market share impact, which is there. How do you see the rising fulfillment center cost and the competition which is there on the margins for Nykaa?
So I think on the fulfillment cost, they are already largely invested on a pan-India basis. In fact, if you look at their fulfillment cost, it is 5% of AOV. As I said, for other platforms, it is reasonably higher in the range of 15-25%. Another thing to note here is that they are doing QC initiatives as well. So we do see fulfillment cost, kind of going up from here on. But because the AOV is so premium, there is ample amount of cushion to recover this from the customer. And another reason is the platform fee, the handling fee. I think that is actually about 5 odd rupees. And with their kind of a premium customer cohort, this can actually go to 12 to 15 rupees also. We have seen this in the case of Blinkit. Blinkit charges anywhere between 5 to 12 rupees per customer on a per order basis. So they could also go that path. So I think fulfillment cost not a worrisome sign because of premium AOV. There's an opportunity for this to be recovered, from the customer. I think the larger picture here is the QC competitive intensity kind of seeing a cool off because Instamart, Zepto kind of players are not expanding as aggressively as they were. The price wars are seeing a cool off. You have got Amazon, Flipkart in the business who are expanding aggressively, but they are getting up into their own market share in terms of their own e-com BPC channel. And obviously, they are not 1P-led model. They are more 3P-led model. So this is a premium BPC category where you need trustworthiness of the product, where you need to have 1P control. And that's when Nykaa has an advantage versus other platforms as well.
How do you look at fashion? While BPC is a strong engine for Nykaa, do you see fashion emerging as the second engine for Nykaa? And within fashion, if you look at it, there's a lot of competition which is also coming in there, right? There are multiple categories and premium. As you go up the chain, it becomes much more competitive as well.
So I think fashion as a segment doesn't contribute a large chunk of valuations as on today. I think they've just broken even right now. In the last 4 to 5 quarters, losses have come off. They are largely at a break-in point, and going ahead, they will achieve profitability therein as well. I think invariably the guidance is that they will go to mid-single-digit EBITDA margin in the near to medium term in the fashion business as well. But I think the silver lining in fashion business is again the premium AOV. If you look at online fashion as a segment, the AOVs range between 1,000 to 1,200 rupees for other larger platforms. But for someone like a Nykaa, again, this is 3 to 4x. It is very similar to where the BPC market has panned out for them, targeting with the premium customers. Because again, herein you've got a cushion to charge the customer. You can spend on fulfillment because your AOV is higher. It doesn't hurt you. And I think fashion is a very different segment altogether because fashion returns are very high. It's more than 35% for the industry, and BPC returns are less than about 10%. So fashion, in terms of how things pan out, is a multiple. But yes, there are 2-3 levers here also. Their recent partnership with Nike, because of which they saw growth rate. Some bit of improvement in margin on a consistent basis. Again, the valuation, as I said, is sub 10% for Nykaa's market cap today. If they execute well on fashion, if they go to a reasonable margin of 7-8% EBITDA margin in the next 2 to 3 years, if they continue to grow well and expand their premium customer base, you could get some bit of value over there as well. But it will not be a big driver for Nykaa's target price is what we see right now. It could incrementally contribute from maybe a 5-6% towards a 10-12%, 15% contribution. But large chunk of the valuation will be driven by BPC.
Karan, I'm curious to know, with regard to QSR, you've seen some bit of a re-rating play out, right, on some of these names. And it's been a very healthy one at it. But give us a sense, what's in store? And, could there be something structural to the story, 3-5 years?
See, from a QSR standpoint, one has to see that, of course, most of these companies have reported very healthy SSG in Q1. And potentially, we do believe that this kind of SSG momentum will sustain in Q2 as well. Now, one would have actually thought that this Q1 SSG is also coming at the back of base, because last year, the base was low in terms of, Navratri base impact, which is there. So adjusting for that, the SSGs largely have been higher. But the point I'm trying to make here is that even from here on, the momentum is going to be there because very clearly there's a positive impact of GST. If you remember, the GST cut happened around September, October. And that had a positive impact on the entire consumption space across various categories. And we had done a deep dive over there in terms of the various categories and the impact. What we saw very clearly is that whatever benefit that is going to come in the form of discretionary spends or in the form of the consumer wallet, a large part of those spends will go into verticals like, food, travel, and apparel, right? But what has happened is that this impact has come with a lag. So when the GST cut happened, the biggest delta was created in automobiles and in white goods and durables, where the savings were higher. So consumers lapped onto these categories, lapped onto these kind of products because the savings were higher. And we did call out that time that, the impact on industries like apparel and food will come with a lag. And I think there is some bit of positive impact of this sort also, which is playing out, because we did assess that, you could see a revenue upgrades of 2 to 3% for the food companies as well, basis the wallet share going to discretionary spends in terms of the consumer savings on the GST cut. So that is a factor which is playing out right now. Another important factor which is playing out is obviously some bit of reversal in dine-in, some footfalls coming back on track. Delivery was obviously the faster growing channel. That was always the case, but some bit of footfall revival, dine-in coming back on track. I think these companies have invested very aggressively in terms of creating dine-in only offers, and that's driving, footfalls back on track. Third, I think, is obviously the competitive intensity. I think there are certain categories where the competitive intensity is also easing off. I think look at the case of pizza. You did see La Pino's, Mojo Pizza, many other pizza players scaling up aggressively, adding new stores on franchise basis. But what is happening? The end franchise is not able to, make that much amount of money or ROIC that they would have assessed. So the expansion plans have, kind of come back. So this is another reason in terms of why in certain categories, lower competitive intensity is also leading to better growth for the incumbents. So I think the momentum will continue for the next couple of quarters. I think you could also see price hikes, many of these companies, because what's happened for them is that so far in the last 2 to 3 years, inflation has been quite supportive, but now inflation is going to come. So you will see price hikes. Plus, I think a lot of these companies are focusing on value meals. So they lost out on margins because of that as well. So as I said, in categories like pizza, where the competitive intensity will cool off, you will see margin expansion because of these two levers, some bit of price hike, and also, the food inflation, kind of increasing from here on.
Play QSR, therefore, Karan, do you play through the leader where you're suggesting that there could be a margin expansion in the works? Is that how you play?
So as of now, I think QSR one could definitely play with Jubilant Foodworks because they've got a higher delivery split. So we believe that, delivery as a channel will continue to grow faster. We're not confident that FY28 SSG will remain, mid to high single digit for most of the other QSR players because there's a structural issue here. Other QSR players, except Jubi, drive only 45% of revenues from delivery channel, which is the fastest growing channel in the country today. So I think there is still kind of uncertainty in terms of how things are going to pan out over there. But, we also like Devyani Sapphire, given the merger, given the synergies that they're going to see in the next 12 to 15 months, you could see some opportunity therein as well. So the preference remains to be highly skewed towards Jubilant, followed by Devyani Sapphire.
Karan, give us a sense of your take on quick commerce and the impact that we are seeing on the retailers like Avenue Supermart. Do you see the full play out of QCS through, at least in some of the saturated markets, and now it would be a gradual gain in share for Avenue, or it's still to see how it plays out?
I think, for Avenue, there is going to be a constant pressure as far as LFL is concerned. I think, obviously, this quarter, you will see LFL being higher versus last quarter, largely because of price hike. Because price hike implementation happened around May, there was 1 month of inventory. So that way, Q2 will ideally be stronger because of the price hike positive impact. In case we see another round of price hike in the next month or so by FMCG companies, you could see better LFL growth in the coming quarters, for DMart. But I think X of price hike, expecting growth of 7-8% on a steady state LFL basis seems to be a concern right now. Because what was happening, let's say about 2 to 3 years back, is that QC was only scaling up in the metro market. And now the aggression in metro market has increased as compared to what it was, because earlier you had only 4 players driving the QC market. Now you have Amazon, Flipkart also driving the QC market. So I think competitive intensity within the metro market has increased. So let's say if DMart's LFL in the metro market was at about 3-odd%, it has now come to 0-odd%. Potentially it can even go to -1, but not go to 3-odd%. So I think there's no reason in terms of why DMart LFL will see acceleration given increased competitive intensity in the metro market. That's the first thing. Second, I think the only safeguard that they have is non-metro market. So currently, as we speak, non-metro market is quite mixed. The way QC is scaling up, it will take some bit of time. Metro market scale happened in 3 to 4 years time frame. Non-metro may take 7 to 8 years, right? But again, that is invariably going to hit their LFL in the medium to long term perspective. So I think the only lever that DMart has got is store ads. They've been guiding for adding 80 to 100 stores every year. And they've been, even guiding for moving to lease model if needed. So if they add more than 120, 150 stores every year, you could see better growth for DMart. But, the ask rate on LFL, for the LFL to go from 7% odd which is penciled into our estimates to 8-9%, seems to be tough as of now. Another question that DMart has as of now is margins, right? I think the QC price was rated margins of DMart in the last 7 to 8 quarters. That is largely behind us as well. So there is cushion in terms of margins. There is cushion in terms of store growth. These are the only two variables that you will play DMart for. But I think LFL is a tough ask, for asking any kind of improvement. So I think DMart right now, as we speak, the valuations are, kind of favorable. We don't see further downside in the stock. But the upside will only depend in terms of how they add stores, how the throughput for the new store pans out, and if at all they're able to maintain this 7-8% LFL that we pencil in right now.
Okay. Thank you so much, Karan, for coming in and speaking to us as always. Very good speaking to you.
Thank you.